Well, good morning, everyone, and thanks for tuning in on this sunny Wednesday morning. I hope you're all keeping safe and doing well. My name is Mike Sitrick, and I'm Vice President for Advancement of the DuPage Foundation. With me today are Amy Van Polen, Senior Director of Bridge Communities, and Terry Cicero, a Principal, Certified Financial Planner and CPA with DHJJ, an accounting firm and financial advisory firm based here in the western suburbs. We are pleased to welcome you to today's program, Resetting and Responding. When our three organizations began collaborating on this event, we'd originally planned for it to be an in-person presentation focused on planning strategies and shifting landscape. Little did we know then just how timely a topic that would be. From the onset of the COVID-19 pandemic to several changes in the tax law as a result of the recent passage of the Secure and CARES Acts, there's a host of new challenges and opportunities for all of us to navigate. During our time today, we'll look at some effective ways to help you do just that as you reevaluate your financial, retirement, tax, and charitable goals within this shifting climate. Several of you were kind enough to submit questions in advance of today's program, many of which we've attempted to address within the presentation, but we encourage you to submit additional questions as they arise using the Q&A feature available on your screens. We also have some time reserved at the end for questions, which Amy will moderate. But before we get to the heart of our program, allow us to provide you with a brief introduction of my organization, the DuPage Foundation, and our partner charity, Bridge Communities. Next slide, Kate. So for those of you unfamiliar with the DuPage Foundation, we are a public charity and one of more than 750 community foundations across the country. We've been serving our community for nearly 35 years, and we are DuPage County's philanthropic leader, committed to helping our residents do a world of good in their own backyard. You can think of us as the engine that drives giving throughout DuPage County, and we do that in three ways: by helping people and organizations give effectively to the causes they love, providing critical support to our community's not-for-profits through our grant-making and initiatives, and fostering key partnerships to address critical issues affecting our county. In terms of impact since our creation, we've granted more than $45 million on behalf of our community and beyond from our hundreds of charitable funds. And locally, our grants are doing incredible things. From helping our area not-for-profits feed the hungry, to providing critical care, resources, and training to transform the lives of individuals and families, to supporting DuPage's vibrant arts community and beautiful open spaces. In short, we're committed to inspiring philanthropy throughout our community and are here to help people of all ages, interests, and backgrounds realize their passions for giving back to worthwhile causes that are making a difference in good times and in times of crisis like the present. So during today's program, you're going to learn about a number of giving strategies to assist you. And as you consider them, we encourage you to keep the DuPage Foundation in mind as your partner. Whether you're looking to streamline your giving to multiple organizations, create a permanent charitable endowment for your favorite causes and charities, or be a part of a coordinated effort to respond to the most pressing and urgent needs of our community like the COVID-19 crisis, we're here to help you and your team of advisors arrive at the most effective and efficient solutions. And in addition to our charitable services to individuals, families, and companies, we also work closely with our not-for-profit community to support their needs. Apart from granting millions of dollars each year on behalf of our residents and donors, we also partner with scores of not-for-profits to help them achieve their endowment building goals. One such organization is Bridge Communities, which has been a grantee of the foundation since 1995 and a valued agency partner since 2003 when it established the first of several endowment funds with us. At this time, I'd like to introduce Amy Van Polen to tell you a little bit more about her organization and the fantastic work that they're doing. Amy?
Thank you, Mike. Good morning, everyone. I want to thank you for joining us today. And I especially want to thank DuPage Foundation and DHJJ for partnering with us and providing this wonderful information for you all. As Mike mentioned, Bridge Communities is a proud partner of DuPage Foundation. And since 1988, Bridge Communities has been providing homeless services to families in DuPage County in a very unique way by marshaling hundreds of volunteers and partnering with faith communities and dozens of other organizations to not just provide shelter, but to provide long-term solutions for each family so that they can work independently towards their own goals and work towards their own financial stability and long-term independence. Bridge Communities provides three key resources to every homeless family: safe housing, a team of dedicated mentors, and a wide variety of support services, including case management, education, employment, nutrition, auto donations, and many others. And throughout our last 33 years, Bridge Communities has worked with over 850 families to transition them from homelessness to permanent housing, ensuring that not only this generation, but for generations to come in their family unit, they are able to thrive in so many ways. Bridge Communities has created Cornerstone Society as an opportunity to honor friends just like you who have made a gift to the future of Bridge Communities through a gift in their will, living trust, or other giving vehicle. Your gift to Bridge Communities through our Cornerstone Society would truly change the lives of so many homeless families for many years to come, while it would also achieve your financial, tax planning, and giving goals. And finally, it would leave a lasting legacy of generosity for many years to come. If after listening to today's presentation, you'd like to get more involved with Bridge Communities, there's many ways that you could do so. You could volunteer with us by mentoring a homeless family, tutoring, organizing a donation drive in your community, donating your car to Bridge Communities, participating in a fundraising event, or giving. If you would like to learn a little bit more about becoming a member of our Cornerstone Society, please contact me after the presentation today. And I do, again, want to thank you all for joining us. I want to thank you for your interest in learning more about these critical topics. And I appreciate any interest that you would like to learn about Bridge Communities. And with that, Mike, I'll turn it back over to you.
All right. Thanks, Amy. We're
You're
glad to
welcome.
have you with us today as a partner. Next, it's my pleasure to turn things over to our keynote presenter, Terry Cicero of DHJJ. Terry, before getting into your presentation, could you tell us a little bit about your firm and practice?
Sure. Thanks a lot, Mike. It's great to be here today. I'm Terry Cicero with DHJJ. We are a CPA and business advisory and financial advisory firm. We have offices in Naperville and St. Charles. Our firm specializes in closely held businesses and business owners and helping them with their business planning, along with family wealth planning, estate planning, charitable planning, and also working with high income earners, high net worth individuals. Today, what we're going to focus on, I'm excited about today. There's a lot of good info here that we want to bring to you and bring you up to speed on recent acts, the CARES Act, Secure Act, and also a brief update on where income tax rates are, where estate taxes are, and then we'll get into some charitable giving strategies. So again, this is for you today. So we want to make sure we're focusing on what you want to focus on. So to start, we will mention if you have some questions as we go, please put those in the Q&A. And if they're on topic, Mike can deliver those to me as we talk, and we'll also have plenty of time at the end to answer questions. So please, if there's something you want to know, please put that in the Q&A section. So with that, if we're going to have a quick poll question to start off, just to gauge who's in the audience today. That helps us to know who's out there and who's on today. So which of the following best describes you? If you can just quickly answer if you're retired, employed, self-employed, or a business owner, if you're unemployed or a student. And we'll give you a few seconds on that. Should be an easy question. All right, we'll close that up, Kate, and see who's on the call, who's on the webinar today. Okay, so we have a very good mix of people. It's good to see. It helps today to sort of spread the focus on different things. And if we can do one more question, the second question will help us to, which we could probably gauge on who answered the first question. Some people in retirement may be more geared towards retirement plan changes. So which of the following topics are you most interested in? More IRA and retirement plan changes, an income tax update, estate and gift update, or a charitable giving update? I know it's hard to choose. I'd have a hard time choosing too, so. All right, we'll close that up just so we can gauge the audience there. Okay, that's great. It's good to see that. So it looks like, you know, people do have multiple interests, so that's good to see the different interests and what you are interested in. So we're going to spend, and that is about a good grasp of where we're going to try to spend some time on the new changes with retirement, but wrap it up with charitable giving and spend some time there in that arena. Okay, so with that, we'll move forward. Again, there's a lot of info, and again, we're going to gear this more towards charitable at the end. So starting with the recent act and the Secure Act, we're just going to touch on the important things that changed here. We're not going to go into great detail. We're available afterwards for follow-up questions. So if we don't get into too much into the weeds here, please follow up with us or with your advisor. All right. So with that, with the required distribution age, that has increased to age 72. So prior to this, it was age 70.5 before you were required to take your required distribution. Now it's all the way up to age 72. So you do get a little more time before you're required to take your IRA distribution. The one thing we'll get into with the CARES Act, which is coming up, is that did get deferred for this year. So we'll cover that in the CARES Act, but just know that beginning going forward, it's age 72. Now, the age limit for traditional IRA contribution, that was also removed under the Secure Act. So the Secure Act is on 29 for, it looks like, yeah, I'm sorry about the, Kate, we just fixed that. It looked like the poll was still in the background there, so we got that taken care of. The age limit, it used to be if you were over 70.5, you couldn't deduct a traditional IRA contribution and put into a traditional IRA. All that went away. So if you're still working into your 70s and want to contribute to a traditional IRA, that is okay now. It used to be you can still do to a Roth, but now you can still do a traditional if that makes sense for your situation. There's one caveat there. If you do give and you plan to do what are called QCD, which will later go into greater detail on the qualified charitable distributions, which some of you may already be doing, there is an effect on that as when you make a post 70.5 deductible contribution, it taints the charitable distribution from your IRA later. So again, we just want to be careful if you're in your 70s and you want to give, and you're still working and put into an IRA, and you want to do a qualified distribution to a charity from your IRA later, talk to your advisor before you do that. All right, this third point with elimination of the stretch for the IRA beneficiary, this is really the most significant thing that came out of Secure Act. It's been talked about for a few years now. Under the old rules, if your beneficiary used to be able to take the proceeds of the IRA out over their lifetime. Now they need to take that out and empty it over 10 years. So if a parent passes away and it goes to the spouse, that's still okay. The spouse can still take it over their lifetime, that's fine. But if it goes to the child or children, they need to now take it over 10 years instead of over their lifetime. So that's a big difference for somebody who may be in their 40s or 50s who inherits an IRA. Before, they used to take that out over their lifetime and maybe just add a little bit of income every year to their tax situation. Now they have to take that out over 10 years. So this is very significant. So it's important to revisit now. We'll talk about this in a second. We're just going over the rules now about planning because of this. Now stretch remains, that fourth point, for certain beneficiaries like a spouse or a minor child till their age of majority. And then the last point is the 5-year rule remains for the non-designated beneficiary, for a charity or an estate. So we'll go to the next slide, which talks about some planning considerations. So again, that was the rules. This is very important, especially if you have a significant 401k IRA. These rules will apply to that. Leaving this to a beneficiary. The more beneficiaries you have, the more that it gets spread out amongst multiple people. So if inheriting this now and taking it out over 10 years, you do have the option to be flexible with when you take that out over 10 years. There's no mandated 10% per year. You can wait till year 10 and take it all out. Does that make the most sense though? There's a lot of tax planning now that comes into it. So In light of all this, just a few things you want to be looking at. Review your beneficiary designations, because it doesn't matter what your will says. Your IRA is what's called a qualified asset. Your retirement assets have a beneficiary designation on them. So you need to make sure that the beneficiary on file matches your wishes. So it's very important, even absent this change, always make sure your beneficiary designations are up to date. You may want to name a charity or donor advised fund as a beneficiary. So we'll talk about donor advised funds in a little bit, but keep that in mind as you're reviewing this, that you may want to, because you thought that, oh, I thought my child could take their IRA over their lifetime, now they need to take it out over 10 years, that's going to be a bigger income tax hit to them. So maybe you'd like to name a charity instead for a part of that. You may want to consider what's called a charitable remainder trust as a beneficiary. Very briefly with the CRT, essentially, that trust would be named as the beneficiary of the IRA, and then the trust would get the IRA and the proceeds that come from it. But then during the term of the trust, you can do 20 years or whatever term you'd like, the beneficiaries, meaning maybe perhaps your children, get the income and it spreads it further, but then the charity gets the lump sum at the end of the term. And it may not be for all of your IRA, you can do it for a portion of your IRA. So keep that in mind. It's, again, just giving you some ideas, not going into great detail, but we want to make sure you're aware of some things and the importance of just revisiting the IRA beneficiaries. Lifetime Roth contributions may make sense. Essentially, with lifetime Roth contribution conversions, if you convert your IRA to Roth, you pay tax now, but then there's tax-free growth. So that sounds all good. You just need to weigh the tax today versus what you or someone else would pay in the future. So if in retirement, you're in a lower bracket than perhaps you perceive your beneficiaries may be, it may make sense to bring in some Roth conversion and get it over to Roth so that they're not stuck with big IRA distributions when they inherit an IRA. There's no right or wrong answer here. These are just considerations to think about. Life insurance is just another consideration. Because we're going to accelerate some of the tax, does it make sense to have some life insurance to help pay that, or to better leave a tax-free asset to someone rather than the IRA itself? And again, this can be in coordination with a charitable beneficiary. This is why all this is important, because it really plays into the whole overall estate plan and your charitable plan. With that, revisit your estate plan. It's very important to do that in light of everything going on in these changes. Won't go into great detail with the different trusts, but more beneficiaries means more spreading out the income. Review existing trust docs. Work with your attorney. You need to make sure the trust docs have the right wording in them. Does it accumulate what's in with those distributions? Because old rule would have said, oh, we get to take that out over the lifetime of the beneficiary of the trust, but now it's the 10 years. So do we have to keep what's in there and distribute it out, or does it stay inside the trust? So those are things you need to revisit. You should be revisiting. All right, we'll go on to the next slide. So with the CARES Act, in March was passed, and let's see if, yeah, I think we passed up one of the poll questions. So this one came up. This will be for the future, but we'll ask it now because it popped up. I'm not sure if we can go back and get the other one, but with the tax will come up to in a minute, but do you itemize deductions on your tax return? Is the poll question we have now. It looks like Kate was able to take that down. We'll bring that back up in a minute, so thanks, Kate. So the CARES Act passed in the midst of everything going on with COVID-19 in March, passed pretty quickly with the big news in the CARES Act was the PPP, the payroll protection for businesses, and the recovery rebates, those payments for individuals. That was the guts of it to get more money into the economy. There were some changes we need to be aware of. That's what we're going to focus on here. Charitable changes for individuals for 2020. There's now only for 2020 a $300 above the line deduction. This is per tax return for non-itemizers. So if you don't itemize your deductions, then you can make a $300 contribution and deduct that above the line. And it's got to be to a public charity and not to a donor-advised fund. The limitation for itemized deductions was 60% of your income. For 2020, it's 100%. So if your income was $200,000, before you were limited to 60% of that for how much you could deduct in a year. Now for 2020, it's 100%, and that's for cash contributions, not for capital gain property. And we'll get into that a little more too. For corporations, cash gifts are now 25% of income, and food inventory gifts are 25%. So not huge changes in CARES for charities, but something to be aware of. The big thing for the CARES was for retirement accounts for 2020, there is no required minimum distribution. So where we just talked about, it was 70.5, then 72. Well, forget all that for 2020. You do not need to take a required distribution. So this is pretty significant, very significant, because if you do not need to take out from your IRA, why do you want to pay tax sooner than you need to? So if you already took your RMD, maybe you take it monthly, does it make sense to put some of that back or put that back? You do have the option, there's a 60-day rollover to put that back. So you do have up until July 15th, the IRS came out and gave guidance. As long as you took out after January 31st, you still have till July 15th. They extended the 60-day to put that back in and treat it as if it didn't occur. So there's some planning, and we'll talk about planning too, because if you don't have that IRA coming in, do you still have room in a lower tax bracket to bring in some income? And that's where a Roth conversion may make sense. So again, work with your tax advisor on that to say, okay, if we don't need the IRA, should we still bring in some income from a Roth conversion, which could work well now with the Secure Act and not leaving as much traditional IRA to your beneficiaries. All right, we'll move on to the next slide with a tax update. All right, we just want to touch on estate and gift. Federal estate taxes are not an issue for many, many, many people now, because under tax reform at the end of 17, the estate exemption was raised so high, it's really excluding a lot of people from having any estate tax issue. You can see now it's up approaching $12 million. So that gives you a lot of room to not have to pay estate tax. Now, 2025 tax reform is temporary. So back to 2025, this could drop back to about half that. So keep that in mind, because there could be people in between there, and you may want to use that exemption while it's there. So again, hopefully working with your estate planning advisor on that. The Illinois exemption, this is really important. I'm sure we have plenty of people from Illinois on the phone, on the call today. The Illinois exemption remains at $4 million. So in essence, you could be safe from estate tax for federal, but for Illinois, you potentially could have an issue if you're more than $4 million. So keep that in mind too. Annual gifting, $15,000 per year you can give to someone without any issue, without dipping into what are called your coupon, your 12 million coupon. So with estate tax, again, work with your estate planning advisor, your attorney, who's ever working with you on estate planning. It's a low interest rate environment. You can see the rates right there right now. There's some vehicles, I'm not going to go into detail on those vehicles, but in essence, certain vehicles favor a low interest rate environment. They're favorable to you as the gifter to utilize certain vehicles in a low interest rate environment. The last thing just to point out while we're on estate and gift is to don't neglect the non-financial aspects of planning. So it's not just, okay, I'm okay from an estate tax standpoint, I don't have to worry about the estate tax. That may be fine, but what about the non-financial part? You know, especially if you have kids, who takes care of the kids, that's really important. But also, who's going to manage my affairs, who's going to make sure everything goes to who it's supposed to go to. You know, so now if you have health issues, healthcare power of attorney, financial power of attorney, a living will, all those things an attorney can draft for you. All right, Kate, I don't know if we have the question for estate. There's a poll on estate and charity. If you have that, we can pop that up now. If not, we can just go to the next slide. And Mike, if there's any questions on point 2, we can bring those up too.
Terry, let me circle back. I've got 2 that came up with regard to when we were talking about the corporate deductions under the CARES Act. Just looking for a clarification, is the corporate in-kind limit only for food donations?
For food, that's correct. That's the only one that was increased, was the food one. That's correct.
And then I had another question too. Is the Illinois exemption $8 million if you're married?
Correct. It's per person. So there is a $4 million per person.
Awesome. Thanks, Terry.
All right, Kate, we can go, if you have the charitable, the estate and charitable poll question, you can pop that up, or we can just go on to the next slide. All right, we're going to go on to income tax rates and where we are from an income tax standpoint. This is important because you want to have an idea of, if you are going to give to charity or you're going to take IRA distributions or Roth conversion, how much tax are you paying? That's really important to know, because this is sort of a control that we have to bring in income, defer income, deductions, what rate are you offsetting? So this is what I call the fun stuff, to sort of fill in these different brackets and where we are. We put up here prior law 17, because remember, the tax reform now, sometimes referred to the Trump tax cuts that are out there, go till 2025 under current law. And again, that can be changed at any time too, if Congress and President were to act on something more favorable or less favorable. But rates historically are lower right now than historically, and even from the prior laws, which were lower than some history going back further in time, where rates were higher. We also get more income sneaking in at lower brackets. So you can see for 2018 to 2025, where 24% bracket goes all the way up to $326,000 of taxable income for joint filers, whereas before it was 28% to 238 and 25% to 156. So you could bring in more income at historically lower rates. You have to know though, what rates are you going to pay later versus now? So, and it flips the different way for a deduction. If you're paying higher now and lesser later, does it make sense to bring in more deductions? So we just wanted to put that up there. We'll go on to the next slide to give you an idea of those rates. We just put up the capital gains and qualified dividend rates to remind you that those lower rates are out there. Not all income is treated the same. So if you have long-term capital gains, investments held more than a year, or you have stock dividends, those get a lower rate. If you're in the lowest bracket, so under the tax cuts and jobs, you can see at the bottom, if your ordinary income is in the 12% bracket, you get a 0% rate on your capital gains. That's very significant. So if you're in that rate, you want to look at that and say, is there room to bring in more actually and pay 0%? At the same time, if you're giving to charity and you're already paying 0%, now that's great, we're giving to charity, but is there a way to yield some tax benefit from that charitable contribution? bring in some Roth conversion, something like that. So again, tax planning is significant here. All right, going on to the next slide. It's important to know the difference between the standard deduction and itemized deductions. The standard deduction pretty much doubled under tax reform at the end of 17 to 2018. So now we're at a standard deduction. This is at 18, it was 24,000. You can see indexed each year for inflation. So for 2020, we're now up to 24,800 for a married couple, and half that for a single filer. But in essence, so just remember itemized versus standard. Standard's about 25,000. It's a nice, easy number. And if you're over 65, add about 2,500 to that. So just round numbers, 25,000, 27,000, okay? So keep that in mind, that $25,000 number, as we go on to the next slide. So what can we itemize? We try to keep it simple, and Congress has by getting rid of some and limiting some. So you have medical expenses, but it's got to be more than 10% of your income. So if you have 200,000 of income and 10,000 of medical, your floor is 20,000, 10% of 200,000. So only what's above that. So if you have 22,000, you deduct 2,000 in that case. So a lot of people don't deduct medical, which is a good thing. State and local taxes, this was the big thing with tax reform, where it's now limited to $10,000 per tax return. So if you have property taxes and state taxes of 30,000, you're limited to 10,000. So keep that in mind, because that's pretty much a 10,000 base for most people, especially if you're working and pay state taxes. Mortgage interest we add in, and then charitable contributions we add in. So remember that overall limit increase got increased to 60% from the tax reform, and for 2020, it's 100%. Now, capital gain assets, that's 30% of your income. So if you're at that 200,000, you'd be 30% of that, or 60,000 if you're giving stock. Now, if you have a private foundation, which are less and less popular now, but they're still out there, 20% limitation for capital gain assets to a private foundation. So let's go back to that $25,000 threshold we're dealing with. Remember, for standard deduction, pretty much you have the 10,000 of state taxes or property tax, and then you still have 15,000 a room before you exceed the standard. So if you have no mortgage interest, if you've paid off your mortgage, pretty much that means your first $15,000 of charity that you give only gets you up to the standard deduction. Which means if you give 14,000 to charity, you're still going to take the standard deduction. Now, if you gave 20,000 to charity, you've got your 10 of taxes plus your 20 of charity, so you have a 30,000 itemized. So that's great. We got 30,000 of itemized deductions, but you would have had 25 anyways. So you gave 20 away, and it sort of only yielded 5,000 extra of benefit. So we're going to talk about what can we do to still give what we're giving, but benefit. So we'll go on to the next slide, and I think this is where we can pop up the poll question about itemized. So do you itemize deductions on your tax return? And it's okay to be honest. I mean, some people know for sure, some people don't know, and all right, we'll see what the audience says on this one. So it's good to see. A lot of people do itemize, so that's great. And that could be mortgage interest helps out a lot there. People that have a lot of mortgage interest helps puts them up, and people that are charitable, which I think a lot of people on today's presentation are. And we'll go one more question on the next one is another one on the itemized. So this is the tricky part where if you did itemize, were you above the standard deduction threshold before deducting your charitable? So that's that example where I said, if are you getting full, you know, are you getting that full benefit from your charity? So were you already above the standard deduction? So if you had, in that example, already 10 of tax and you gave 20 to charity, were you you would have needed, say, 10,000 of tax and 15,000 of mortgage interest to be above 25,000 to get full benefit of your charity. So just curious, trying to gauge out there, and we'll see that that answer. So it's good to see the ones that are above it. That means presumably they had a significant amount of mortgage interest, more than 15,000 probably of mortgage interest, or a lot of medical. And some don't know and some didn't itemize. Okay, thank you, Kate. Okay, we'll go on to the next slide where we're going to focus on charitable giving now. So just a quick recap. Are you taking the standard deduction? So you can go back, look at your tax return. Are you taking that $24,000, $25,000 number, or if you're over 65, closer to 26, 27,000? Are you taking that? Or is there a Schedule A with your return that is more than the standard deduction? Sometimes the Schedule A will still get filed, but it won't be more than the standard. So you're just checking to see if you're taking the standard or not. The second point is what we just did the poll on. Are you itemizing, but total itemized over the standard is less than charity? So again, that example where your 30,000 of total itemized includes 10 of charity. So in this case, 10 of taxes, 10 of property taxes, 10 of property taxes, 10 of mortgage interest, you're already at 20. And then you give 10 to charity to put you at 30. Well, you're not getting a full benefit on that full 10. It's like only what's in excess of the standard. So how do we get benefit? That's what we want to talk about here.
Terry, excuse me just for a second. We've got
Yes.
somebody raising their hand in the crowd. I just
Sure.
want to remind folks, if you have a question, please go to the Q&A feature down at the bottom of your screen and submit your question, and we'll get that answered for you.
Thank you, Mike. Yeah, we're very happy to answer questions as we go here, because sometimes I'll go through things too quickly, or I want to make sure everybody understands what we're talking about, because these are really things for you to utilize to benefit your tax situation, get more dollars for you, and ultimately to give more to charity too, if you would like. So how do we get benefit? That's what we want to talk about here. So bunching charity is one option, but sometimes that's not the best answer. You don't want to give all the money to charity at one time, perhaps. Maybe you want to spread it out. Maybe at their end too, that makes sense. They'd rather know that we're getting so much per year. So a donor advised fund is pretty much the most popular and somewhat easy answer. We'll talk about that in a minute. The qualified charitable distribution is another option. We're going to talk about that in a little more detail. And then the third option, not as popular, but it's still an option, is what's called a non-grantor charitable lead trust. So those are the three most popular things. There's also a private foundation. We're not going to go into a private foundation today. The private foundations are becoming less and less popular because of the cost to administer those private foundations. So we can talk about that too, and if there's questions on those, we can answer them. But we'll go on to the next slide for charitable giving.
Terry, really quick follow-up on that. Do you see a lot of people converting their private foundations to donor-advised funds to save on admin costs?
It's a great question. I was talking to a colleague today in the office, and we were going over how many foundations we had to file this year. And the number is down because we had 4 convert last year, and it was their final year the year prior. So, and that's where, I would say that we went from maybe, 20 to 15. That's how, when that many fall off the radar. And that's a continuous theme, because there's a lot of, I don't want to say there's a lot of hoops, but you do need to make sure you are maintaining and administering that private foundation. And a donor advised fund, as we'll talk about here, is just so much easier. So if you do have an existing private foundation, that's where you can talk to somebody, including somebody like DuPage Foundation and Mike, about converting that to a donor advised fund. It could make a lot of sense.
They're pretty easy to convert.
So overview of the donor advised, or the DAF, is that first you give to your donor advised fund after you set it up. You can put cash, you can put stock, you can put other appreciated assets that make sense. Even it's possibly you can put some of your business in there too. There's some complex assets too. Typically though, you see this with appreciated securities. You can use cash, so that's fine too. Then in essence, it gets invested and you see it grow, presumably, to give you more dollars to give away over time. And then you make the grant recommendations to give out to charity as you wish. So instead of you writing checks, the donor advised fund itself is cutting those checks or dispersing those funds to the end charity over time. So the end charity in their mind doesn't really change. They're still getting their donations just from a different, they still see who it's from. If it's from the Terry Cicero Donor Charitable Gift Fund, they see that it's from that, but that could be under the umbrella from a DuPage Foundation, or if there's smaller ones like from a Schwab or a Fidelity, that may, if you're doing one for a smaller dollar amount, you can set one up with them. So they're pretty easy to administer. And again, from the end charity standpoint, then they're still getting their money. So going on to the next slide with donor advised funds. Just a few reminders, you get a current year deduction for fair market value. So whatever you're putting in, you deduct today. So even though the charity, the end charity is not getting their dollars until the future, the donor advised fund, the charitable gift fund itself is a charity that allows you to deduct everything that you put into it. So if you put 50,000 in and it grows to 60, 70,000, your donation is 50,000 the time that you put it in, but you still have more pool of money to give out later. The front loading of future years may make a lot of sense, because if you are higher bracket now and you go to a lower bracket, you may want to give more today, especially if you have some appreciated securities. If you're at the 37% bracket today, and then you're going to retire and your income's going to go down, maybe to 22%, even 12%. Well, if you still plan to give, you know, 10,000 a year to charity every year, or whatever the number is, if we could bring that in sooner, you yield a higher tax benefit from doing that. What's nice is you don't need to track your gifts and grants for tax reporting. So you put in the 20,000, 50,000, whatever amount you want to start the fund with, 100,000, you deduct it all, then you never need anything for taxes, because everything after that is at the charity level, which is nice come tax return time, not to have to, all right, let me gather up all my receipts and who I gave to charity. It makes it so much simpler for you and for the tax preparer also.
Hey, Terry, we have a great question about donor advised funds. Ben reached out and asked if we see Congress potentially requiring some minimum level of distributions on donor advised funds. As folks know, private foundations have a minimum 5% payout. There's currently no restriction on donor advised funds, and they tend to have a much higher payout rate. Traditionally, do you have thoughts on that?
It's a great question. I get that one too, probably not every presentation, but it does come up. And there's been nothing that's come to front on that. So will it become an issue as donor advised funds get larger and larger and larger, because they are growing and growing? It's possible, but I have not really seen anything on the horizon there. So at this point, there's nothing out there that mandates or requires, or that Congress is looking at to make sure you are, in essence, recommending grants. You can put in 100,000 and just let it sit there and not dole out anything. So we haven't seen that come out, and I haven't seen anything on the horizon. We'll continue to watch for that, because it could become an issue as these get bigger, possibly.
From what I've read and seen, the payout rates for donor advised funds tend to average between 15 to 20% between community foundations and commercial proprietary funds like Fidelity's and Schwab and that.
Yeah, there's still a decent amount, because there's a good mix of why people use them. Some people may just say, I have, just for simplicity, and this is where, you know, you can use someone like if you have, just using a simple example, say I have Amazon I bought for $2,000 and it's now worth $20,000, and I want to give $20,000 to charity. Well, but I have 10 different charities I want to give $2,000 to, okay? Well, I don't want to go and give one share of Amazon to all those different charities. It's a lot easier for me to throw those in a donor advised fund and then have the donor advised fund cut those checks. So if I could do that simple, then what happens there, I just gave out 100% of my DAF, you know, the next day. So that could skew some of the things too, because we do see that too. That's not typical example, but that's one where I could usually use the one that at Schwab just to make that happen. All right, back to the donor advised fund, and that no need for tracking. Then we get on to, you name your end successor or charity. So if you're the owner and perhaps your spouse is also on there, or the successor, after you and your spouse were to pass, you can name your children or child to, or any individual to take over for you. They don't get the money, but they step into your shoes to give to charity. Or you can name an end charity. Perhaps you let the fund keep it itself to dole out how they wish, or you have a specific XYZ charity in mind that you may want to give to. And we mentioned the ease of administering, and I just wanted to make sure we reiterate versus the private foundation. So, all right, we'll go on to the next slide. And we do have a poll question about donor advised fund, just to get an idea real quick of who's out there. So before today, how familiar were with you? Were you unfamiliar or somewhat familiar? You know of them? Very familiar, or you actually have one, so we can gauge. All right, we'll close that poll. Okay, good mix, very good mix of people, and it's good to see some have them. So, all right, we'll close that, and we're just going to do an example real quick. It sort of just reiterates what we talked about. If you're giving $15,000 a year to charity, but you take the standard deduction, so over 6 years, your standard is $160,000. But what if instead you front-loaded the donor advised fund with $90,000? So you get to deduct that $90,000 plus your $10,000 of property taxes. So you're deducting $100,000 plus the next 5 years, you still get the standard. So your cumulative deduction over the 6 years is $233, versus if you just continued on making an annual gift, you took the standard. So you get an additional deduction of almost $73,000. And at the 37% rate, that's an extra $73,000 in your pocket, simply by not giving anything additional, just by the timing of when you put it. So you can see how the significance of the $27,000 extra from that deduction of the $73,000. It's an extra $27,000 in your pocket. All right, next slide. So if you are over 70.5, you do have what's called the qualified charitable distribution option, which goes direct to charity. You can do as much as $100,000 per taxpayer per year. So even though that RMD age went up to 72, this is still 70.5. And both spouses can do up to $100,000. And it's got to be from the IRA, can't be from an employer plan. So if you don't have an IRA and everything's still in 401k, you can roll over some or all of that to an IRA if you do want to take advantage of this. Has to go to a public charity, can't be to a donor advised fund or your private foundation. So what's nice is this counts towards the RMD. So not a big issue this year, but any other year where you have, say, if you have a $80,000 RMD, you can satisfy that or a portion of it with this QCD. So if you give $50,000 direct to charity from the IRA, that means you only need to take 30 more out. So you don't pick it up as income when it goes direct to charity, but then you also don't deduct it. So keep those things in mind, and it's, again, you can weigh what makes more sense for you. We'll do an example on the next slide to help put numbers to it. So Fred and Wilma give $15,000 each to charity. So again, that's total. So 15,000 plus 10,000. Remember that 25 is less than the standard deduction. So they're taking the standard. So they're not really getting a tax benefit from the charitable gifts. And I should have put tax benefit. They are getting a benefit of giving to charity, but the tax benefit is not there. So it's worth pointing out too, when you're over 65 and paying Medicare premiums, some of us, I'm sure, are aware of that income-related adjustment for higher Medicare premiums when your income's higher. So because they were over 174, that's 180,000 that puts you over. So what's the opportunity here? Well, there's the donor advised fund, right? But let's look at the QCD because they're both over 70.5. Well, if instead of writing checks to charity direct from their pocket, what if they put $7,500 from their IRA? That reduces their income by $15,000, and they still take the standard deduction. So now they get an extra $15,000 of reduction to income. In this case, their lower bracket, 22%. So they save $3,300 a year, and they don't pay higher Medicare premiums. So again, moving parts here, something to look at. But definitely something you want to keep on the radar and utilize. All right, next slide. So we're not going to spend much time on the non-grantor charitable lead trust. Just know that it's out there. It's a little more complicated because it involves setting up a trust document, where this is not your standard charitable lead trust where typically the charity gets money at the front, you get an annuity and then an income level, and then at the end you can take it back. With this one, the best way to explain it is with an example. On the next page, we'll go through an example because that's the best way to understand this, where they're giving $15,000 to charity each year, but they take the standard deduction. Well, if they have $300,000 of bonds sitting in a taxable account making 5%, they're picking up that income every year, and they're paying tax on that income. So when they're paying tax on that income, that, you know, $6,800 of tax that they're paying every year. But they're turning around and giving that $15,000 to charity. So is there a way somehow we can do something here? So what if they funded this trust with $300,000 of bonds, and then that income that the trust generates goes to charity? Because it's in the trust, nobody pays tax on that $15,000 because it went direct to charity. So that's pretty significant that they could be saving that $6,800 a year. Over 6 years, that's $41,000, which is actually the best, the winner out of the three. But again, it's a little more administrative. You got to file a 1041, a trust tax return every year. So again, just wanted to bring this to your attention. The donor advised fund makes a lot of sense. The QCD makes a lot of sense. And then this just is another option for you. Okay, next slide. So just some other considerations. Year-end planning is so significant. Some people just give to charity and it is what it is without knowing what the tax benefit is. And that may be fine, but let's really look at it and work with, we can work with you, or your advisor can work with you to say, well, here's the benefit of giving more to charity this year because you're higher bracket. Or do you realize your income is pretty much made up of capital gain income where you're paying 0% or 15%? Maybe you want to offset higher rate income. So let's bring in some Roth conversion. Multi-year planning, very important. Just don't isolate in 2020. Look over future years too. And don't forget estate planning considerations. Do you want a charity to be a beneficiary? Or maybe a percent? Or maybe you set up a separate IRA where the beneficiary is 100% your charity. All right, next slide. And I think we wrap up with, you know, just your takeaways, just a reminder, 300 above the line if not itemizing. So if you're leaving here today with some action items, you know, if you don't itemize, there's one thing. Elimination of the stretch. That's very important. Please revisit your IRA beneficiaries, retirement beneficiaries. No required RMD for 2020. And in light of that, does it make sense to bring in some Roth conversion or do something else? Maximize your tax benefits of charitable giving. So those things we just went over, the QCD, the DAF, and the trust option. Finally, just ending with election results, they may have an impact on income and estate tax. So again, nobody knows who's going to win the election, but if where things are today versus where they were just a few months ago, looks like a much closer race, just not at the president level, but also in Congress and at the Senate level. And if the Democratic Party were to sweep, that could have an impact on income and estate taxes. So not to say that Republicans won't either, but the current tax climate to 2025 could change sooner. So what's nice is we will still have the end of year after November elections to pivot if we need to. And so just keep that on the radar and working with your advisors at year end. So with that, I will toss it back to Mike and Amy and to see if there's any other questions and to wrap up.
Thanks, Terry. This was great. We've got a few minutes left, so I was going to hand things over to Amy. She was going to field some questions if any of you guys have them through the Q&A feature.
Thank you, Mike. Yes, please, anyone who has questions, please just type those in and we'll make sure those get passed to Terry or to Mike or myself.
I do not see any popping in. I'm going to proceed with our wrap up, but if something does happen, please feel free. We'll get those answered. Just to close things out, I want to thank Terry again for sharing his knowledge with us, and thank Amy and all of our partners at Bridge Communities for everything that you're doing for our community. We're delighted to be able to highlight your work today and put on this program. As we close, thanks to all of you for tuning in. We know this is a very strange time with a lot of uncertainty, but we hope you found this information valuable. Please keep supporting your favorite charities as you're able. And if we can be of help to you in your planning work or in figuring out where and how to give effectively, please don't hesitate to reach out to any of us. Our contact information is on the screen. Maybe Kate, could you pop that back up? I think that just disappeared. Just want you to have that. Following today's program, you will be getting a short email with a survey, a copy of today's slides, and a link to the recording of the webinar. We'd greatly appreciate your feedback. And lastly, just a special thanks to my colleague Dave Balsowitz and to Stephanie Ganzi from DHJJ for their help executing today's webinar. Couldn't have done it without them. So I do see two questions. Let's get those. Here we go.
It looks like a question popped up for you, Terry. It says, what does 100% AGI for 2020 mean?
So basically that just means you can deduct as much as your income for only this year. So in where your income is 100,000, you can deduct up to 100,000. May not make a lot of sense to do that because you aren't going to get a lot of benefit for doing that from a tax standpoint. So do work with your advisors. If you are looking at making significant gifts, make sure you understand the benefits of doing that, assuming that tax benefits and yielding as much as you can from those is a goal of yours.
Awesome.
All right, thank you for that, Terry. Doesn't look like we have any other questions. So Mike, if you want to wrap up.
We are at 11:30, right on the mark. So thanks everybody. Have a great rest of the week and reach out if we can help.
Thank you.